The card in your pocket feels like a modern invention. Plastic, a magnetic stripe, a number that opens almost any store on earth. The usual story starts in 1950 with a small club in Manhattan handing cardboard cards to a few hundred businessmen. But that date is a trap. Two things it hides are older and stranger than the card. The machine that decides whether you are allowed to borrow was already running, decades before the plastic. And the card you carry was not born then. It took shape 30 years later, inside a courtroom in two state houses. To understand the trap, go back to a country that had almost no money, not no wealth. Early America was rich in land, in timber, in crops standing in the field. What it lacked was coin. Hard currency was scarce across the countryside, and a farmer might go months without holding a silver dollar in his hand. So rural commerce ran on something older than cash. It ran on the ledger behind the counter of the general store. The storekeeper wrote down what you owed in a heavy book, and you settled up after the harvest came in. There was no contract, no collateral, no credit limit, no score. The only thing securing that debt was your reputation, which the storekeeper had been assembling for years out of everything he had seen and everything the town had told him. Your credit was gossip, refined over decades into judgment. He extended you goods because he knew you and because he had known your father before you. The word credit itself comes from the Latin for belief, and that is what it plainly was. Someone believed you would make good on your word and staked real goods on the belief. In that world, owing money was not a neutral financial condition. It sat much closer to a moral failing, and sometimes to an outright crime. A man who could not pay might be locked inside a debtor's prison until he somehow produced money he plainly did not have. These were not brief holdings. In many places, a debtor was not freed until he acquired the funds to pay or work the debt off through years of hard labor, and a good number of them languished there and died, imprisoned for the offense of being poor. Which makes the eventual invention of bankruptcy law radical. It replaced punishment with release, treating a ruinous debt as a misfortune to be discharged rather than a sin to be jailed for. The sharpest proof of how far that went sits in Philadelphia, in a jail on Prune Street. Consider the man who financed the American Revolution, who signed the Declaration of Independence, and who served as the young nation's superintendent of finance. His name was Robert Morris. When a wave of enormous land speculations collapsed in the closing years of the 1790s, his creditors came for him. For 9 months he barricaded himself inside his own house, leaving only on Sundays, the one day of the week a man could not be arrested for debt. In 1798 they finally took him to Prune Street, and there he stayed for roughly 3 years. George Washington came to dine with him inside those walls. His own business partner, John Nicholson, was jailed the same way and died behind bars owing more than $4 million. Morris did not walk free until Congress passed the country's very first federal bankruptcy law, written partly to release major debtors like him, and only then, in 1801, did the gates finally open. Hold on to that image because it tells you exactly what credit meant. If the richest financier in the country could be jailed over a bad bet on frontier land, then debt was danger, and whoever held your debt held real power over your life. The nation would not abolish imprisonment for debt at the federal level until 1833, and everything that follows in this story is one long argument about the single question the storekeeper faced with his ledger. Who keeps the book on you, and how much are they allowed to know? The first real answer to the title's question, how ordinary families paid for what lay beyond their means, came from an unlikely object, a sewing machine. In the 1850s, a Singer's sewing machine cost around $100, a devastating sum for the very households that most wanted one. Isaac Singer had built the machine. His partner, a sharp New York lawyer named Edward Clark, built the thing that changed American life. In 1856, Clark introduced what he called the hire purchase plan. $5 down, a few dollars a month, and the machine came home with you today while you paid it off over the coming year. Stop paying, and a man arrived at your door to carry the machine back out again. That last detail is the entire invention. Clark had cut credit loose from character. The old storekeeper needed to know your soul, your family, and your habits before he would risk a dime on you. Clark did not care in the slightest who you were. The machine itself was the collateral. If the payment stopped, he repossessed the object and resold it, so the only fact he needed about you was your address. A farm wife in Iowa or Kansas could order the machine by mail, receive it within weeks, and pay it off in egg and butter money while it was already earning its keep on her table. Sales nearly tripled in a single year. The company was also condemned fairly. for hauling back machines that families had very nearly finished paying for, which tells you the trick had a cruel edge from the beginning. Then the automobile put the whole thing on an assembly line. Before this, banks almost never lent money for something as frivolous as a car, so a buyer either paid cash or scrounged up private financing on his own. General Motors ended that in 1919 when it created a lending arm called the General Motors Acceptance Corporation, built to hand ordinary families the money to drive a new Chevrolet off the lot for around a third down. It worked so completely that by the middle of the 1920s, most new cars in America were being bought on time rather than paid for in cash. And the same trick soon reached into the home. Refrigerators, washing machines, vacuum cleaners, radios, all of it became affordable as a monthly payment rather than an impossible lump sum. By the end of that decade, roughly 3 out of 4 cars and trucks in the country were sold on some form of installment plan. Buying on credit had shifted from a mark of failure into the ordinary way a household acquired almost anything large. One man despised every bit of it. Henry Ford regarded buying on installment as a kind of moral rot, living beyond your means dressed up as freedom. He fought back with an old-fashioned save-first scheme, the Ford Weekly Purchase Plan, in which you handed your local dealer a few dollars every week and could take the car home only once the account was finally full. Americans wanted the car now, not the sermon, and they carried their business to the companies that let them have it. Ford lost the sales crown to General Motors, and in 1928 he surrendered and opened his own auto loan company. The moralist had read the country correctly and still lost to it. Americans had decided collectively and for good that they would rather owe than wait. The installment plan had answered the literal question, yet it carried a hard limit locked inside it. Every one of these loans was chained to a specific object that could be hauled away again: a machine, a car, an icebox. None of it followed you from one town to the next, and none of it handed you open-ended spending power to use anywhere you pleased. For that, someone first had to build a machine that could keep the storekeeper's book on everyone in the country at once. That machine already existed, and almost nobody ever says its name. In 1899, 2 brothers named Cater and Guy Wolford started a small business in Atlanta called the Retail Credit Company. They walked door to door among local merchants asking what they knew about the people who shopped with them, and they wrote every answer down. They marked each customer with a blunt rating, prompt, or slow, or requires cash, gathered the findings into a volume they called the Merchant's Guide, and sold each copy for around $25 to anyone who wanted to know whether you were good for it. It began as a natural, almost innocent thing. A merchant only wanted to know before he handed over goods on trust whether the stranger across the counter tended to pay, but scaled up and sold nationwide. That innocent thing curdled into something no single storekeeper had ever intended. Over the following 60 years, that modest book swelled into something vast and deeply unsettling. The Retail Credit Company built files on millions of Americans, and those files reached far past whether you paid your bills on time. Investigators recorded your marital troubles and your drinking. They wrote down whether your house looked clean, what the neighbors murmured about your sex life, and which political meetings you were seen attending. Rumor and hearsay went into the folder right beside verified fact, and the company was said to reward its own agents for coming back with damaging material. The finished dossier was then sold to lenders, to insurance companies, and to employers, who used it to shut the door on anyone the file judged morally lacking. You could not read what it said about you. Vast numbers of people never knew their file existed at all. The people in those folders had done nothing wrong. They were ordinary citizens whose private lives had been cataloged and priced, and the same folder that could deny you a loan could just as easily cost you a job or an insurance policy on the strength of a whisper you would never be shown. For decades this stayed in the shadows because paper is slow and scattered by nature. Then, around 1970, the company announced it would computerize, pulling all those secret dossiers into a single database that could be searched and sold in seconds. That announcement is what finally dragged the system into the light. A Columbia University law professor named Alan Weston went public with what the company was hoarding, spelling out for everyday readers the intimate detail packed into those files. Public fury hardened into congressional hearings, and the hearings produced a law. On the 26th of October, 1970, President Richard Nixon signed the Fair Credit Reporting Act, the country's first consumer financial privacy law. For the first time, you held the legal right to see your own file and to challenge whatever was false inside it. The secret book had been pried open, if only by a crack. Here is the irony worth pausing on. The law did not kill the credit bureau. It cleaned it up, legitimized it, and ushered in its golden age. The retail credit company, by then so widely distrusted that its own name had become a liability, rebranded itself in 1975 under a word you know very well today: Equifax. The story did not end with the moral dossier. It ended with the moral dossier converted into pure arithmetic. Back in 1956, an engineer named Bill Fair and a mathematician named Earl Isaac had founded a company on a single wager that a formula could predict whether you would repay a loan more reliably than any human judgment ever could. In 1989, that company, Fair Isaac, released one standardized number distilled from your credit file: the FICO score, a figure running from 300 to 850 that claimed to sum up your entire financial character in 3 digits. By 1991, all 3 national bureaus were selling it, and once the mortgage giants Fannie Mae and Freddie Mac required it in 1995, it became nearly impossible to escape. The score did something subtle and permanent. It swapped a story about a person for a probability about a risk. The lender stopped asking who you were, or even whether you had paid before. The lender asked only what the number said, and the number never explained itself. Trace what happened to the storekeeper's judgment across 2 centuries. It began as a man who knew your name and your father, remembering whether your word was good. It arrived, in our own time, as a number generated by a formula you are not permitted to see and cannot sit down and argue with. With that file machine humming quietly in the background, the card could at last arrive. And its origin story is a small masterpiece of American marketing folklore. The tale goes that in 1949, a businessman named Frank McNamara finished a dinner at a Manhattan restaurant, reached for his wallet, and discovered he had left it at home. Mortified, he supposedly swore he would never be caught that way again. It is a charming story. It is also, by the later admission of one of his own partners, largely a fiction polished up to help sell the concept. What McNamara and his partners truly built on the 8th of February 1950 had no charm at all and enormous consequence. Diners Club. The founders liked to call that first paid meal at a spot called Major's Cabin Grill the first supper. The real invention was never the piece of cardboard, which at first opened doors at only a couple dozen restaurants around New York. It was a 3-party network. You ate at the restaurant. Diners Club paid the restaurant on your behalf. Then, at the end of the month, you settled a single bill with Diners Club that covered every place you had used the card. The company earned its money from both sides at once. A fee of around 7% charged to the restaurant for the service of being paid, plus a small yearly membership fee charged to you. Within about a year, the club had signed more than 40,000 members. For the first time, one card worked at many separate merchants who shared no other connection with each other. If you are the kind of viewer who wants the real machinery behind the things you carry every day, rather than the tidy legend printed on the box, take a moment to subscribe. The strangest turn in this entire story is still ahead of us. The idea spread at speed. In October of 1958, American Express launched a rival card. That same year, out in Fresno, California, Bank of America cracked a problem that had defeated everyone before it. A card is worthless until enough shops accept it, and shops refuse to accept it until enough people already carry it. A perfect deadlock with no obvious opening. Bank of America broke the deadlock by sheer force. It mailed 60,000 live, ready-to-use cards entirely unsolicited to residents across Fresno in an event remembered ever since as the Fresno Drop. Overnight, there were tens of thousands of cardholders in a single city, some of them delighted, some of them fraud waiting to happen, and the merchants had little choice but to follow. But Bank of America bolted on one feature that outweighed all the rest, and it is the feature that built the world you live in now. Revolving credit. With Diners Club and American Express, you cleared your balance in full at the close of every month. The Bank Americard let you pay only a portion of what you owed and carry the remainder forward, with interest charged on the balance you chose to keep. That one change transformed a convenience for wealthy travelers into a borrowing instrument for ordinary households. The card stopped being a way to pay and became a way to owe. Interest was no longer a penalty for slipping behind. Interest had become the product itself. Bank Americard would eventually grow into Visa. A competing alliance of banks built the network that became MasterCard. Between the two of them, they finished the job the credit bureau had started. Your creditworthiness was no longer trapped inside one town's memory. It was portable now, riding along in your wallet, honored 2,000 miles from anyone who had ever laid eyes on you. This was a real feat of engineering, though not the kind you can photograph. The networks had to move money and trust between thousands of banks and millions of strangers, settling debts overnight between a diner in one state and a bank in another, all on the promise buried in a string of numbers. The plastic itself was almost incidental. Underneath it ran a clearing system, invisibly reconciling who owed what to whom. And here is where the title tells its biggest lie by omission. The card you picture, the universal one with revolving credit and a rate north of 20%, was not legal in 1950. It would not have been legal in 1970 either. That card was engineered between 1978 and 1981 by judges and legislators rather than by any inventor. Through the 1970s, an old body of law still bound what a card could charge you. State usury caps, some of them centuries old, set a hard legal ceiling on interest, and those ceilings held card rates down to numbers that would look almost quaint today. Then came a lawsuit out of the Midwest. A national bank in Omaha, Nebraska was charging its cardholders across the state line in Minnesota an interest rate that Nebraska allowed, but Minnesota's own usury law forbade. A Minnesota bank sued to stop it. The case climbed all the way to the Supreme Court. On the 18th of December 1978, the court ruled unanimously in Marquette National Bank versus First of Omaha. The decision turned on a single old phrase buried in the National Bank Act, which lets a national bank charge the interest rate allowed by the state where the bank is located. The justices took those words at face value. A national bank is located in its home state, and so it may charge its home state interest rate to customers anywhere in the country, regardless of what the customer's own state permits. First of Omaha could lawfully charge a borrower in Minnesota the 18% that Nebraska allowed, even though Minnesota capped the rate at 12%. Lawyers gave the principle a name: interest rate exportation. Weigh for a moment what that unleashed. If a bank could export its home state's interest ceiling to the entire nation, then the ceiling that mattered was no longer the one where you happened to live. It was the one where the bank chose to plant its card division. And so the states began to compete by racing their own usury limits down toward the floor. Those old usury ceilings had stood, in one form or another, since the founding, a centuries-old break on how much a lender could charge the desperate. Within a few short years, that break was gone across most of the country, dismantled through a quiet scramble between state houses rather than any vote in Congress. South Dakota moved first, and it moved out of desperation. The state's economy was in real crisis. Farmers and small businesses starved of credit because high interest rates had made lending there unprofitable under the old caps. Its governor, Bill Janklow, met privately with Walter Wriston, the chief executive of Citibank, in what amounted to a handshake deal. Citibank was drowning in New York, unable to charge enough on its cards to cover its own soaring cost of money. Janklow offered a bargain. South Dakota would abolish its usury ceiling entirely, and Citibank would move its card operation to Sioux Falls and bring several hundred jobs along with it. In 1980, the legislation was introduced, passed, and signed into law on the final day of the session. When New York saw the bank preparing to leave, its own legislature panicked and rushed through a moratorium on its usury limit, but the damage was done. Delaware watched the whole thing unfold, understood the game perfectly, and repealed its own limits the very next year in 1981. That is the real reason your statement now arrives from Sioux Falls or from Wilmington. The address on your bill is no accident of geography. Those two small states wrote the interest rules the rest of the country lives under, and the money followed the rules straight to them. Across the early 1980s, as card lending at the nation's banks exploded, roughly half of that entire increase landed in Delaware and South Dakota alone. Two states you could pour, together, into a single large city, while banking jobs and tax receipts vanished from the places the money had left behind. By 2003, almost 3/4 of all credit card loans in the United States were being issued out of a small cluster of states holding only about 4% of the country's population. A ceiling meant to protect the borrower in Minnesota or Ohio had been replaced by whatever rate two tiny states chose to allow, and those states had every incentive to allow almost anything. The revolving, effectively uncapped card in your pocket was engineered by lawmakers, inside one courtroom and two state houses. So the title's question deserves a truer answer than the one it invites. People have always bought what they could not afford. What changed across 2 centuries was who kept the book on them, and whether that judgment stayed in human hands. And this is where an honest accounting has to close the ledger, on both sides, at once. Start with who the machine let in, and who it kept out. Well into the 1960s, a married woman with a salary of her own generally could not get a card in her own name. The bank wanted her husband's signature. because the law still carried an ancient assumption, older than the country, that a wife had no separate financial identity, that she was, in the old legal phrase, a covered woman. Her affairs folded entirely into his. That did not end until the Equal Credit Opportunity Act of 1974, which finally made it illegal to deny credit on the basis of sex or marital status. And the cheap government-backed consumer credit of the mid-century, the loans that built the post-war middle class, was handed out along stark racial lines. The federal housing agencies that stood behind those mortgages graded whole neighborhoods on color-coded maps, marking black and mixed districts in red, instructing appraisers to downgrade any block where the population was integrating and refusing to insure loans in and around those areas. Black families with sound credit were turned away for reasons that had nothing to do with whether they would repay. That practice earned a name of its own, redlining, and it was not outlawed until the Fair Housing Act of 1968. The single greatest engine of American wealth building ran, by deliberate design, in one direction. The gap it opened did not close when the maps were finally retired. Families locked out of that cheap government-backed credit could not build the home equity that became the main inheritance of the American middle class, and the distance still shows in the wealth ledger today. Now weigh what the institution truly gave you in return. Near universal access to credit for the first time in human history, spending power that is portable, honored almost anywhere, freed at last from the small town's tyranny of knowing your entire life. A machine that judges a stranger by the same rule it applies to a neighbor is, in its own cold way, a kind of fairness the old storekeeper could never offer. And weigh what it took from you in exchange. A permanent, invisible file that trails you from cradle to grave and that you almost never see. A rate the founders of this country would have prosecuted as criminal usury, now printed on your monthly statement as ordinary. And access that arrived last, and grudgingly, for the very people the old system had already shut out. None of this adds up to a simple verdict. A ledger has two columns, and both of these are full. The same system that freed a young family from the judgment of a small town also bound them to a file they could not read and a number they could not question. Two quiet echoes should tell you the old machinery never really stopped running. The service now sold to you as buy now, pay later, splitting a purchase into painless little installments through an app on your phone, is Edward Clark's 1856 hire purchase plan wearing a new interface. Nothing about it is new except the screen, and every time a merchant accepts a card, the network skims a fee of roughly 2 to 3 cents on every dollar, a cost the merchant folds silently into the price marked on the shelf. For years, the networks even forbade shops from charging cardholders extra to cover it, which guaranteed the fee stayed hidden inside one price paid by everyone. Which means the person paying cash at the register is also paying for the card, subsidizing a system they never joined, in precisely the way the coin-poor country store once charged its credit customers a little more and called it nothing at all. So the answer was never really the plastic. The answer was always the book, kept on you by someone else, and the fact that for most of this history you were never once allowed to open it and read your own name. That book is still open. It is still being written. And it is still running quietly on you.